Okay guys, welcome to video number 3. So quickly, let's review what we actually learned in video number 2. So we took a much deeper dive into the differences between professional level traders and retail traders. We really got into how the industry works and actually why it's so damn hard, so ridiculously difficult for retail traders to break out of unconscious incompetence. There's just so much misinformation and infrastructure that is literally designed to keep retail traders at a level of total unconsciousness. So for people in the retail world who obviously have full-time or part-time jobs or run businesses, for people who have little time to figure all of this stuff out for themselves, it's almost impossible to make your way through the vast amounts of misinformation and false perceptions of what professional traders actually do and break out of unconscious incompetence. It's almost impossible to figure this stuff out yourself. You'll just be on if you engage in all of the things that, or all of the practices that are recommended out there, and also that the infrastructure predicates. Okay, you'll just stay on an unconscious loop forever. So for people that don't have the time to really figure this out themselves, it's almost impossible. It's a really tough job to be able to get access to the right information, learn it, understand it, and apply it, okay? Most people are just going to stay on this unconscious loop forever. So, in the last video, other than showing you the differences on a deep dive, other than showing you the infrastructure and how it's built, not for the real benefit of retail traders, it's really set up for people to fail. Other than showing you that, we started to show you some of the ways in which professional traders approach the markets in a bit more detail, okay? So what did we look at? We looked at the concept of absolute return versus the concept of alpha, and that professional traders really are going for an absolute return mandate. We also introduce you to the concept of portfolio risk and volatility versus the return that you're actually targeting. It is possible in the real world to target a certain amount of portfolio risk and volatility to get a certain level of return. Retail traders just don't understand that concept at all. But this is bread and butter stuff for professional traders. We also introduced you to the time horizon spectrum and where the volatility sweet spot exists in equity markets. Where does it exist? It exists in the 1 to 3 month long-short portfolio management space. How we use also, we introduce you to how we use the Pro Trader systematic framework for trade idea generation, how we actually come up with our trade ideas, how professionals generate trade ideas over and over again, and how we build long-short portfolios within that systematic framework, and how and where risk management actually fits in. What we also introduced you to as well was what actually constitutes a trade idea in the professional world. What are the inputs in the systematic framework that constitute a genuine trade idea at a professional standard? So, the approach of professional traders, unfortunately guys, contrary to retail trader perceptions, the approach of professional traders has actually never changed. This is what you've got to understand. You obviously have to understand the key differences between professional traders and retail traders. And we've been through a lot of those. We've done a deep dive in the last video. Not only that, by default, of course, when you look at the major differences, the key differences, you're going to pick up, by default, the industry landscape, the parameters, how it actually works, how financial markets actually operate, okay? So you're picking up those two things, okay? When you pick up those two things, knowing the difference between professional traders and retail traders, understanding the landscape and the infrastructure, this is the beginning of how you climb out of unconscious incompetence. You have to understand the differences, understand the industry, and set yourself up for the best chance of success. Of course, success is not guaranteed, but by knowing those two things, you stand a chance. You stand the best chance. Not knowing those two things, unfortunately, you don't stand a chance. If you're going to do many trades over a long period of time, over a career or a lifetime, you have to understand the differences between pro traders and retail traders. You have to understand how the industry works and where you fit in as a retail trader. And you have to take professional level trading strategies and replicate them, emulate them, and do the work, and emulate them in your own retail trading accounts within the retail trading infrastructure. So there's a key ingredient now that's missing. If you understand the differences between professional traders and retail traders, if you understand, you have digested and you have understood well the way the industry works, you've got your head around it, okay? And you've admitted that you've previously didn't know how it worked, but now you know how the matrix works, how the infrastructure works, okay? If you've got those two things, it's now time to move on to the key ingredient, which is volatility. So let's move on now to start studying volatility and why it's so important. So let's get into Realized Historical Volatility 1.
Okay, everybody, welcome to video number 3, where we're really going to get into the meat and numbers of financial markets. Now, we mentioned in the previous video, which was obviously a huge video, this is going to be another big one. We mentioned that we were moving on to volatility. So welcome to video number 3, where we're going to be looking now at realized, so historical volatility 1, and we're going to be looking at the distribution of returns of asset prices. Now, this is extremely important to understand as a trader in general, but even more so for retail traders. If you're going to stand any chance of lifting yourself out of unconscious incompetence, this is what you have to understand to begin your journey. So we are going to go right in and dive straight in to some numbers that are extremely important to understand in the financial markets. Once you understand this stuff, you're going to start climbing out of unconscious incompetence. What you're looking at here is a statistical analysis of the S&P 500 daily distribution of returns from the open to the close of each day from 1962 to 2020. Now, as I mentioned, this video is going to be split into 2 parts. What we're going to do first is look through the numbers and understand them. And then in the second part, Chris Quill is going to go through the spreadsheet work with you to show you how this works so you can build the spreadsheets for yourself and understand volatility and the processes to measure it forever. Okay? But first, in the first part of this video, we're going to try and understand the numbers and get the key messages across. It's extremely important. And everything opens with this. Biggest market in the world, biggest equity market in the world, the S&P 500, we're going to look at the daily distribution of returns from the open to the close. So what does that mean? Essentially, guys, we are looking at the volatility capture of day traders of the S&P 500. If you're trading the S&P 500 index and you're a day trader, to measure your potential returns, you're looking at the open to the close. Why? Because that's the volatility you're looking to capture. You open your positions during the day and you close your positions before the day ends. You go home flat. So we're looking at the open to the close data every single day for the S&P 500, the world's largest equity market, where all the most day traders exist in the S&P 500. We're looking at the daily distribution of returns from 1962 to 2020. It's obviously a massive data set. We're looking at it and transposing a trading strategy on it. So we're back testing some theory, and we're saying if we were day traders from 1962 to 2020 and we went into the market every day, what would have happened? What would have happened if we went in every day and day traded the S&P 500 index? What are our opportunities? What is our risk? Essentially, what is the volatility? Now, at this stage, you should have done the PDF that was in the download section of video 2. Very important to just understand basic statistics if you're going into the financial markets, because that's how we look at volatility and how we understand both opportunity and risk in the financial markets. So at this stage, you should have a basic understanding. Now we're going to apply exactly the same principles, but we're going to be looking at financial data, and first the S&P 500 daily distribution of returns, open to close, 1962 to 2020. So let's start having a look at these numbers. What are we looking at in terms of this chart right in the middle of the screen? We're looking at the count. Every day, the occurrences on the left-hand side with gates of performance numbers on the day. So if we look at the open to close daily return range, we can see 0, spot 0, so flat, to 0.5%. And let's move to the right-hand side. We look at the next gate, 0.5% to 1%, 1% to 1.5%, and so forth. If we go to the left, from flat to up 0.5%, what do we have? We have flat to down 0.5%, down 0.5% to 1%, down 1% to 1.5%, and so forth. We are looking at the occurrences within these gates to get an idea what the opportunities are for day traders in the S&P 500. So let's start trying to understand these numbers and this distribution of returns. So we can see the total count of the days from 1962 to 2020 is 14,813 days when this video was put together, when we published these numbers. 14,813 days. What's that made up of? Well, if you look at the table center towards the bottom of the screen, you'll see a column for count. We've got positive data points of 7,801, negative data points 6,921, and days 1962 to 2020, when the S&P was exactly 0.00, is 91 days. We also have a column for frequency. Positive data points, 52.66% of times, there's a positive data point. There's a day when the S&P 500 is up on the day. Negative data points. Frequency, 46.72%. So 46.72% of days we get a negative print on the S&P 500 being down on the day. Let's look over to the left-hand side in the descriptive statistics table. What does this mean? Well, we have slightly more positive days than negative days. So we would expect a mean that's positive, and the mean comes in at 0.028% return average return on a day for the S&P 500 1962 to 2020 over 14,813 days. Something else we need to look at. We need to look at the average returns when we look at positive and negative data points in isolation. So if we take the positive data points, what happens if we just take all the positive data points and look for the average, look for the mean? Well, that comes out at 0.66%. What happens when we isolate just only the negative data points? That comes out at negative 0.68%. This is very important to understand because when we transpose the assumption that we're day traders onto this data, okay, we have two actions that we have to assume occur: buying and shorting. So buying on the day and shorting on the day, there's two actions, okay? Now, obviously, it can be a little bit more complicated than that, where day traders do 10 trades in a day, but we can't really synthesize that. All we know is that 97% of day traders throughout history lose money, and we're trying to understand here and capture the statistics and understand the potential outcomes of some very straightforward and simple actions. So what we're saying here is, okay, if we buy on the open and sell on the close, because we've only got two data points here that we can refer to, if we buy on the open and sell on the close, what's going to happen? If we short on the open and cover on the close, what's the likely outcome? Well, let's have a look at the numbers. So when we apply this action to the statistics going back to 1962, if you buy on the open and sell on the close, well, we know that the market's down in terms of negative data points on the day 46.72% of times. Therefore, you're going to lose 46.72% of times. You're going to lose money. If you short on the open and cover on the close, 52.66% of times, we know that the market's up on the day. So with that action, you will lose money on the day. So with this action, the average returns of the positive and the negative, when we isolate them, we have to essentially probability adjust the outcome. Because when the market opens or is about to open, you have to decide whether you're going to be buying or shorting on the day. The count in the positive data points is 7,801. In the negative, it's 6,921. You're essentially looking at almost a 50-50 outcome of whether when you buy or short, you're going to be right. So we have to probability or frequency adjust the returns. So the average returns in the positive and the negative, when we frequency adjust, are 0.35% with respect to the positive data points and 0.32% in the negative. Now, these numbers will probably come as a little bit of a shock to you. And yes, because you've been under the, a lot of you have been under the assumption for a very long time that there's lots of opportunities when day trading. When you see this information for the first time, of course, it's going to come as a little bit of a shock to you, because you're starting now to probably realize very quickly that this type of approach to financial markets, historically proven with data, when we use daily returns of the S&P 500, is very close to casino-like strategy, i.e. gambling, okay? Now, of course, when people see information that they don't like to see, and it goes against all their preconceived ideas and perceptions of how financial markets actually operate, people get defensive. They start hurling accusations and insults and telling people that their assumptions are all wrong, and trying to point to the tiny percentage probability of outcomes where they've seen exceptions to the circumstances. Whatever, guys. These are the numbers and they can't be changed, okay? And the assumptions are perfectly reasonable in terms of backtesting, where we take 14,813 days. The count is huge, guys, back to 1962. And we put a very reasonable assumption onto the total volatility of the day, open to close. And we say, if we take the simple action of buying on the open and selling on the close, or shorting on the open and covering on the close, what are my odds of making money? And what's my expected return? And the numbers are right in front of you, okay? This is one of the most simplest things you can do in financial markets to begin to understand, okay? And you shouldn't fight the numbers because the market dictates the numbers to you. You can't do anything about the numbers. They will not change, okay? So you just have to start accepting what the real opportunities are over certain time horizons in financial markets. If you can't get this into your head and get it into your head quickly, unfortunately, there's nothing anyone can do for you. We are just the messengers passing on the information and teaching it to you, okay? Try to understand these numbers and try to figure out where you've been going wrong, okay? It's really not that hard. If you can accept these, you will start to climb out of the level of unconscious incompetence. If you can't, you will stay there literally forever. Now, let's have a look at a breakdown a little bit further of the ranges here and the counts within each gate. By doing that, we're going to understand what our probability is of actually making money and making certain levels of money, okay? Certain amounts. If you look at the top table, you can see the count in terms of the frequency column, and you'll see the ranges as well. So you'll see, for example, greater than 2%, 2.23%. Market returning less than 2% on the day, 2.2%, okay? Now, how do we actually understand these numbers? Well, it's pretty straightforward. Let's have a look at the center of the range. If we look at 0.0 to 0.5% in the positive, that's the biggest number at 27.98%. That's the percentage amount of times that the count falls within that range. And then if we look at 0.0 to negative 0.5%, you're looking at 25.1% of times. So what does that mean? What does it mean? Okay. The most probable outcome when you're going long, okay, when you're buying the market, okay, is that you're going to only make between 0 and 0.5%. That's the most probable outcome. And if you're shorting the market on the open and buying back on the close, your most probable outcome is actually you're going to lose. So you're going to, we know the positive count is bigger, but the most probable outcome is that you're probably going to lose between 0 and 0.5%. But let's say you're right. If you're short and you short on the open and you buy back on the close and the market does go down, what's your most probable outcome? Your most probable outcome if the market does go down is flat to making 0.5% on the day. Now, if we look at the more extreme situations where we look at the tails, that's what we call them, the tails of the distribution. This is something you should have learned in the PDF download. The more extreme scenarios in the count. So if we look at, for example, greater than 2%, the frequency probability is 2.23%. So 2.23% of times, 1962 to 2020, S&P 500 daily returns are greater than positive 2%, 2.23% of times. So if you think about that, when we looked at the previous slide and we said, okay, we probability adjust because we have an action. Okay, well, we have to decide to buy or short on the open. If we decide to buy, then we would expect just over a 2% probability. So we're looking here at a 1 in 50 chance, guys, a 1 in 50 chance of making more than 2%. Now, people will argue with this. Of course, they'll say, well, why don't I just sit around for a long time and then just pick the day that it's going to move? good luck with that. Good luck with that. Because this doesn't happen every 50 days, okay? These things tend to happen in clusters. And what will you be doing in between? What will you be doing in between? Well, you could be sitting around doing nothing for 150 days, okay? And then one of these days happens. If you've ever heard the phrase in the financial markets, even a blind squirrel finds a nut occasionally, okay? You've pretty much summed up a day trader having a big day, okay? These are the numbers, and this proves it, guys. Day traders will be sitting around in the S&P 500 at the index level. So remember, we are looking at the index level here. We're not looking at the constituents. The S&P 500 simply represents the average distribution of all of those 500 stocks. S&P 500 index traders, okay? Most of the time, they're sitting around and they're earning, or not, as the case may be, because they still have to pick the right direction. They're basically going to be sitting in the gates in the middle of the distribution the vast majority of times. And occasionally, even a blind squirrel finds a nut. They choose the right side. They buy, for example, and they have one day where they have a big day. They'll make more than 2%, or maybe 1.5% to 2%, or maybe 1 to 1.5%. You can see the clusters when it's 1% and above. It's 5.82 plus 2.51 plus 2.23. Still extremely low probability of a very good outcome when day trading, okay? So making above 1%. Still have to get the right direction, guys. So don't think this is a situation where you have a good percentage probability chance because you're choosing one direction every day, okay? The market still goes down, market still goes up, close to 50-50 throughout history, okay, in terms of days. We're just the messengers here, guys. We're showing you the numbers. We're making some reasonable assumptions. No need to get offended. Just accept the numbers. Look at the numbers, digest them, think about what it means. The market dictates the opportunities over any time horizon. If you understand that and you understand the numbers, we're beginning to climb out of the unconscious incompetence level, okay? Now let's have a look at some of these descriptive statistics. We've already looked at the mean, slightly in the positive, 0.028. The median here, we're looking at 0.042. Standard deviation, so around 68% of times, we're looking at a return that's below 1%. We've got these two numbers here. You can look at the definitions properly online if you want to do that. But essentially, we have a kurtosis number which is in the positive. So the distribution versus a normal distribution. So what the distribution looks like when we compare it to a normal distribution has a positive kurtosis, meaning, well, also a slightly negative skew, meaning that the extreme outcomes are more likely to be negative. And we can see that in the minimum and maximum numbers. So the minimum, so the worst day ever in a day for the S&P 500, down 20%, and the maximum best day ever up just over 10%. So what does this mean when you look at it compared to a normal distribution, when we take the daily distribution of returns open to close and measure it, looking at it next to a normal distribution? Well, it means that we have fatter tails in comparison to a normal distribution, and we end up with a peakier distribution around the mean. Now, if we're looking at that and understanding it properly, what we need to think about here is not just the opportunity, but also the risk. So when we look at the distribution of the daily returns open to close of S&P 500 going back all the way to 1962, and we compare it to a normal distribution with positive kurtosis and a negative skew, basically if we think about that from a risk perspective, not just opportunity, negative outcomes are more likely. So what does this mean? Well, most portfolios in the market run a long bias, okay? Not just over a one-day basis, but over multiple time horizons. Pension funds, hedge funds, mutual funds, much more of a long bias, okay? Generally speaking, at any one point in time, if you go in and take a photograph, the market's long, okay? So the risk is here when we look at past data and we look at the evidence of the moves. There's a lot more very large down moves than very large up moves. And the causality can actually be because the market is generally long. So when the market goes down, it goes down a lot bigger than when the market goes up in terms of the up move. We can see the minimum and maximum. The minimum's twice the size of the maximum. The day, the biggest down day versus the biggest up day. Okay. So we have to also think about this in terms of risk and never forget that. Okay. Because if you're running a long only portfolio or you're running a long bias, you've always got to think about your risk. Okay. And the way the daily distribution of returns is distributed versus a normal distribution for the S&P 500. We have the positive kurtosis, which means it's going to be a lot more peakier around the mean. So a lot more cases, a lot more count around the mean relative to a normal distribution. But we also have a negative skew, which means if we think about it in terms of risk, we have to be very, very careful running long bias because a down day could absolutely destroy us. Okay. So this is why risk management is very, very key. So kurtosis really measures or implies the expected opportunity of what you can possibly make on a one day versus a normal distribution. Okay, this is why it's very important to understand it, because the distribution differs by essentially telling us that versus a normal distribution, if we're looking at S&P 500 daily distribution of returns, there's a lot less opportunity. Okay, and when we look at the risk relative to a normal distribution, we have extreme negative outcomes relative to the positive outcomes, the extreme positive outcomes. Meaning that if we're running long only or long bias in portfolios, that's where we can get hurt the most. So it's very important to understand this stuff, guys, because what you're looking at here, when we look at the daily distribution of S&P 500 returns, open to close, you're looking at the picture of financial markets history. You're looking at the evidence. We're looking at the evidence and the statistics to understand both the opportunity and the risk. The picture of financial history cannot change. It's very important to understand that. Now, something else I want to look at is the particular odds of making money and making a certain amount of money when we're actually choosing the right direction. So when we're either buying or shorting and actually getting it right. Okay. So top table, you can see the probabilities that we're now familiar with, but you can also see the cumulative percentage as well. At the bottom, on the bottom table, this is the familiar table that we saw earlier, which gives us the frequency counts for positive and negative data points with the expected probability adjusted returns. And in the middle of the slide, what we've got here is the assumption that we actually go and choose the right direction with our odds of making over certain amounts of return. So let's say, for example, we chose the right direction by buying. What would be the probability of us making more than 1% on the day? Well, cumulatively, if we work it out from the cumulative percentage column, the odds of making money would be 10%. So 9 to 1, making money over a 1% return. So obviously not very good odds. 10% chance, 9 to 1 odds. What about making over 0.5%? Again, working this out from the cumulative percentage column, you're essentially looking at 25% chance of making over 0.5% based on historical data. So, what are the odds? 3 to 1. So we've got 9 to 1 odds when we choose the right direction of buying, 9 to 1 odds of making over 1%. We've got 3 to 1 odds of making over 0.5%. Not very good odds. What does that mean? Basically, guys, the odds are against you making any decent amount of money. Way against you, okay? Now, let's have a look at the opposite. What about shorting? So shorting on the open and covering on the close. What are the odds of making over 1%? Well, it doesn't really change. Again, we're looking at a 10% chance when we work it out from the cumulative column. 10% chance, meaning 9 to 1 odds. Slight difference of a few percent when we short and cover on the close to make over 0.5% versus buying. But essentially it's the same, guys. It's 9 to 1. Okay, the odds are 22, 23% throughout history. Why would we expect anything different in the future? Do we know something that's going to happen to the biggest stock market in the world over the next 1, 2, 5, 10, 25 years? Do you want to bet your life on it? Do you want to bet an entire career of being wrong and having the odds against you? I don't think so. So, just a lesson here, guys. Making decent money, the odds are always against you. So not just is this really a coin flip where you have to choose the right direction, whether to go long or short on the day, but even if you choose the right direction, the odds of making a decent amount of money are way against you. So this is basically a casino, guys. Trading the S&P 500, day trading it, and expecting a different result to financial history is lunacy. It's idiocy. Now you're beginning to understand why day traders don't make great returns and lose in the vast majority of cases. Over time, over many trades, they just go to zero. Something else that I want to clear up as well. Let's look at the extreme values while we're looking at the table at the top. While we've got this on the page, I mentioned earlier that the negative skew had extreme negative cases much greater than the extreme positive cases. Well, let's qualify that. So when we're thinking about this from a risk perspective, not just an opportunity perspective, if you look at the greater than 2% count, we come in at 331. If you look at the less than 2%, so minus 2%, greater than a 2% move down, we're looking at a frequency, a count of 326. So that's quite similar in terms of the amount of days that the market goes up more than 2% and the amount of days that the market goes down more than 2%. So what does that mean? How do we get a negative skew in this data set? Well, obviously, the moves down, even though they're similar in the amount of the moves up in the extreme, the moves down must be much bigger. Okay, so do yourself a favor when you're looking at this from a risk perspective. Go to the download section, have a look at the S&P 500 daily distribution of returns, open to close, 1962 to 20, and go and have a look at the extreme cases on the negative and in the positive. And you're going to find that the moves down are much greater when you look at over 2% moves. We can see as well from the minimum and maximums, we see that there's a far bigger maximum down day versus versus the most extreme up move. So that was the -20 and +10. So this is all part of the learning process, guys. Go to the download section and go and have a look. Go and have a look in history when those down days were, when those up days were. It's all part of the learning experience. Now, in the download section, there's obviously more indices that you can go and look at. And also, there's other statistics. For example, the high to low range. So instead of looking at the open to close, you guys can go to the download section, download the S&P 500, have a look at the high to low, have a look at the odds there, understand it. You can also look at the Dow, the NASDAQ. There's other indices that we've put in there. Go and have a look at it. Learn these numbers. Very important to understand, guys. Very important to understand. But let's get some conclusions together for the S&P 500 daily opportunities when using open to close, 1962 to 2020. On a dollar for dollar basis, in absolute terms, essentially the odds 50-50. We're no better off really than sitting at a casino roulette table when we're day trading. If we do enough trades over a very long period of time, we still have to choose the right direction. We're going to be wrong 50-50. We're going to be right 50-50, roughly speaking. Okay, not exact 50-50, but very close to that. And we're also exposing ourselves to the fat tails. Okay, the opportunity is not great. We've seen the odds of making over a certain amount of money, certain amounts of return on a day, 0.5%, 1%, when choosing the right direction. The opportunities are not great. And the risk is quite high. Doing it every day forever, when you have the financial evidence right in front of you, is idiotic. It's idiotic, okay? Now, of course, people are going to argue. That's fine. We don't care. We can't change the history. Most people will argue because they're always pointing to the one exception where somebody made money. They're always pointing to the low probability outcome, okay? Where somebody captured some volatility at a certain time period and made some money. Great. What we're saying here is that if you take the approach where you say, I am an S&P 500 day trader, I trade the S&P 500 index as a day trader, and I'm going to do that for the rest of my life. Bad strategy. Bad strategy. Because over a very long period of time, over many trades, the expected return, the expected outcome is zero. The expected outcome is that you're going to blow up. Okay. So of course, people are going to point to cases where some money was made by a day trader in a very particular point in time. Okay. It's not the general rule. It's a complete exception to the rule. Okay. So of course, there's going to be periods when volatility is higher and will present some opportunities to trade in the very short term or on the same day. But they're in the significant minority. And you still have to pick the right direction. Okay. Now, a lot of people also point to a leverage argument where they say, well, on a dollar for dollar basis, the returns are quite small on a daily basis. But what about if I leverage those returns? What about if I use leverage to magnify the 0.5%, to magnify the 1%, to magnify the average return in the up and the down, frequency adjusted, the 0.3%? What if I leverage that? Well, it's not even an argument, guys, because over enough trades, over a long enough time horizon, if you keep doing this every single day and you still have to pick the right direction every day, okay, the expected return is zero. And no matter how many times I leverage zero, of course, I still get to zero. All that's going to happen when you leverage an expected return of zero on a dollar for dollar basis is that you're going to get to zero quicker. Okay. And this is what happens all the time in financial markets. This is why the vast majority, 97% plus of day traders lose money. Now, when we think of this strategy in relation to other potential strategies, so when we try to measure our opportunity cost of capital, there really is no competition, guys. Absolutely no competition whatsoever. Your aim as a retail trader, as outlined in previous videos, is to use your own money to get a consistent return over time. If you're choosing to day trade, if you have this knowledge and you're choosing to day trade the S&P 500, the NASDAQ, the Dow, the Russell indexes, just expect to make a zero return, okay? It's random. It's random, okay? If you choose to do this for a very long period of time or the rest of your life, you're an idiot, okay? You've got the information right in front of you. You can go to the spreadsheets in the download area. You can understand it, okay? But what's good about this is that you can use this exercise and repeat it for different time horizons over any asset, okay? This strategy is not representative of your aim, which is to get consistent returns over time. There is no competition. When you look at different assets over different time horizons, there's better expected returns to be made. Day trading the S&P 500, NASDAQ, Dow is random and expected in terms of return to be zero, okay? Over many trades over a long enough period of time, and using leverage even quicker, you'll go to zero. It doesn't represent your aim. Your aim as a retail trader is to get a consistent return over time. So we have to be in areas of the market where we can get that. Here, we can't get it, okay? Again, we are the messengers. You're looking at financial market history, and the numbers can never change. And they are expected not to change, because that is just a logical expectation when you're looking at over 14,800 data points. Get that in your head, guys, okay? Not expected to change in the future, because logically, why would you expect it to change? Now, before we move on to look at areas of the market where we get more respectable levels of volatility that run parallel or are in line with our aim to use our own money to make money consistently in the financial markets, before we move on to those areas of the market that exhibit the type of volatility that we want, let's have a look at another very popular instrument in the financial markets, the exchange rate of the euro versus the US dollar. Obviously, this is extremely highly liquid, highly traded, the most traded currency pair in the world. It's worth looking at. Why? Because everyone trades it. Day traders gravitate towards it because of its liquidity, whatever. Let's have a look at the numbers. It's going to shock you again. If we go into the market and we say, okay, I'm a day trader, my job is to day trade euro dollar, I can almost guarantee you that the vast majority, I'm talking almost 100%, have never even done this work. Especially retail traders. They don't even know this, okay? To not know it is and say that you're a day trader in euro dollar is absolutely criminal, because you don't understand what the instrument that you're trading. And this is why we're showing you this type of stuff, guys, because again, this exercise can be repeated for any asset in the world, and that's publicly traded. If you can get the data and it's publicly available, which with the internet is very easy to do, you can replicate this exercise with any asset price. And it's worth looking at. We're using these as examples. We're using the S&P 500 because it's the most widely traded equity market. And we're using euro dollar because it's the most widely traded forex pair. these are the products that are always pushed by the brokers, which is another point we're going to come on to soon, okay? So let's have a look at these numbers. Well, in the corner, you can see we've got a count of 5,437 days when we did this study. So what are we looking at? About 20 years plus of data. If we look at the first table and look at the gates, you can see we're using the same numbers as the S&P 500 study, the same gates that we're using. If we look at the count and frequency in the table beneath the chart, you can see out of those 5,437 days, 2,732 were positive data points, 2,665 were negative data points. If we look at our frequency, when we work out the percentage numbers, even more closer to 50-50 than the S&P 500. When we look at the probability or frequency adjusted returns, we're looking in the positive at 0.23 positive and in the negative 0.22. So our expected return here is even lower than S&P 500 daily distribution. And when we're thinking about choosing the right direction, whether to buy or short at the beginning of the day and trading out before the day ends, if we look at the frequencies, that's basically our probabilities of making money when we choose a direction, making and losing money when we choose a direction. So if I buy on the open and sell on the close, I've got a 49% chance of losing money. If I short on the open and cover on the close, I've got a 50.25 chance of losing money. It's even more casino-like than the S&P 500. The numbers are marginal, guys. Don't think that you've got a better chance of making money by day trading the S&P 500 than euro dollar, and there's a big difference between the two. There just isn't. Okay, it's very, very marginal, and we're going to see this in the way the data set is distributed now. So let's have a look at that. So let's have a look at how it's distributed. We've got our gates again, but we're looking at the frequencies throughout the gates. And you can see when we look at the middle of the distribution, we've got from 0.0 to up 0.5%, 1,796 cases. So 1,796 days return in euro dollar, flat to up 0.5%. And then flat to down 0.5%, 1,774 days. So you're basically looking at 33% days of the count in total. Euro dollar market will be flat to up 0.5%, and then 32% of the count, 0 to minus 0.5%. So you're basically looking at 65% of all cases, all days within that range, minus 0.5% to plus 0.5%. Which obviously means the vast majority of times you're going to be within that range as a day trader. And even then, you have to choose the right direction. Is this starting to add up? I hope it is. I hope the penny is dropping. Now let's have a look at the descriptive stats. We've got a mean, which is basically 0. Okay, so if you choose the right direction, you keep doing this over and over again, day in, day out, even if you're using leverage. Your mean is basically 0, guys. It's 0. Okay. If we look at the median, pretty much the same. Standard deviation, one standard deviation out 0.6. Kurtosis and skewness. Kurtosis positive, but only slightly positive at 1.81. Skewness slightly positive, but only very slightly, guys. So what does this actually mean? Well, it means that the distribution is slightly peakier with fatter tails versus a normal distribution. The skew is slightly positive, but it's very, very close to 0. So when we compare this to, say, the S&P 500, and we compare it to a normal distribution, major currency pairs, and this is true for others as well, not just the euro dollar, it's a fairly normal skew and a fairly normal distribution compared to other asset classes. Okay. Now, no one knows exactly for sure why this is, but it's probably because of the size of the market, correlation, liquidity. There's a lot more players and there's a lot more correlation. Okay. So when you're trading euro dollar, guys, and major currency pairs, it's actually even day trading. That is, it's even worse than doing it versus the S&P 500 or major indices. So don't take this medicine from brokers that tell you there's wholesale massive amounts of opportunities to day trade currencies. There just isn't. You're going into this and thinking, as a day trader, if I just leverage these numbers, like we looked at with the S&P 500, if I just leverage these numbers and I magnify the numbers with huge amounts of leverage, 30 times, 50 times, and I get the right side, I've got a huge opportunity to make money. Again, people will always point to the extremes. And, at one moment in time, some dude that made a lot of money quickly in eurodollar. He was one of those guys who, made the 1.5 to 2%, where there's 44 cases throughout history. If you look at the table, he's one of these guys who dropped in that gate for one particular moment in time, or he kept the position on and it came in a cluster and there were 3-4 days in a row because there was a big macroeconomic move, a move in interest rates or something like this. My question to you is this: what's he been doing in between? Nothing. He's been sitting on his hands, waiting for it to happen for years. Or, even worse, he's been active every day because he's completely unconscious. He's been active every day and lost money for a very, very long time. And then he has one big day or one big week. Maybe he makes some of his losses back. Even a blind squirrel finds a nut occasionally. Never forget that. This is what day trading is about. This is financial markets history, and the numbers cannot change. There's a saying in the financial markets: trade what is probable, not what is possible. Okay? Day traders, retail traders in general, these guys who always point to the exception to the general rule, what they're doing is they're falling for a narrative, they're not understanding the numbers, and they're constantly talking about what's possible. Of course, making a lot of money very quickly in eurodollar, it's possible, but what is the probability? Professional traders trade on what's probable, not what's possible. We don't buy lottery tickets. We run a business, okay? And our business is trading, and we trade the probabilities. Speaking of which, let's have a look at the probabilities of making certain amounts of money when we get the right direction, buying or shorting in eurodollar within one day. So let's say we buy on the close of a particular day, and we sell on the close of the next day. Okay, we get the right direction. What's the probability of us making over 1%? Just under 5% odds. Okay, terrible odds. What's the probability of us making over 0.5%? Around 17% probability. 17% odds. Even worse than the S&P 500. On the flip side, what's the odds if we short on a close of a particular day and we buy back on the close of the next day? What are the odds? Well, to make more than 1%, again, it's around 5%. Terrible odds. To make over 0.5%, 17% probability. Terrible odds. If we look at that compared to buying, they're basically the same odds. Okay, that's because, and this is why it's worse than S&P 500. If you look at the way the distribution is lined up, there's much more cases around the mean So you've got a much higher probability of making, say, under 0.5% versus the S&P 500. And there's less extreme, fatter tail moves in the negative and the positive if you look at the table at the top of the slide. Now, something you should be looking at as well, something that I highly encourage everyone to do, go to the download section under this video and download for Eurodollar the file and have a look in the currencies file for Eurodollar. Have a look at the high to low data as well. There will always be people that point, to the accusation or the idea that, using close to close data over a 24-hour period is probably not the right thing to do. I encourage you, go to the high to low data, look at the maximum opportunity over those periods, okay? Over a 1 day period. Look at the absolute maximum and see what numbers you get. You still get very, very low odds, okay? I encourage you to do it for the S&P 500. I encourage you to do it for every asset price you can possibly cover, okay? We're going to cover a lot of asset prices soon. And there's a lot of stuff in the download section. Remember, this is partly an exercise in understanding financial markets history. It's also giving you the tools to understand how to go about things yourself, okay? We highly encourage you to do these exercises and do things yourself. And this is what's going to be covered by Chris Quill in the next video as well. The exercise in itself. What I'm here to do right now in this video is prep you for that. So you start understanding both the opportunities and the risk in financial markets over certain timeframes. So let's have a quick rundown here of the Eurodollar. The opportunity to make money on a daily basis in currency markets, so major currency pairs. We've just looked at the numbers and we understand the context we're in, which is everyone pushes this. Brokers, educators, etc. Day trade currencies. Day trade the major currency pairs. There's so many opportunities. There's millions of dollars to be made, etc., etc., etc. It's even more grossly exaggerated than in the stock market. And it's totally misunderstood by retail traders. Day trading major currency pairs, we've just seen it based on financial markets history on a 1 day basis. It's even worse than day trading major equity indices like the S&P 500, like the Dow, like the Nasdaq, okay? You trade Eurodollar because your broker wants you to, and they're offering you a lot of leverage. You've just fallen for one of the most unconscious financial market narratives out there. Now you know. Now you can do the work. We're starting to raise ourselves out of the level of unconscious incompetence, okay? If you are taught a day trading strategy in the currency markets by a broker, by a charlatan educator, they either know this information and they're therefore being irresponsible, so they obviously have an agenda behind it, or they just don't know the information at all. In the vast majority of cases, they won't know this information at all, okay? If it's at a brokerage firm, maybe the big boss, the CEO, the C-suite, the management, they understand these numbers, okay? But in the vast majority of cases, retail brokers, retail charlatan trading educators, they won't even know this information, okay? Just you knowing this and doing the exercise and understanding it puts you way ahead of everybody else in retail, okay? So listen, either way, if they know it and they're being irresponsible, or they don't know it, either way, they're absolutely to be avoided, because now you know that they're absolutely full of crap, okay? And leverage doesn't make a difference, guys. It does not make a difference. It just makes you go to your expected return, 0, quicker, okay? So what happens here? What's the result? Well, the vast majority of retail traders if you're day trading, are literally writing checks on a daily basis to the market. And they do this for months, years. They blow up 3, 4, 5 times in a row. They can't make money. And they sit there and they wonder why. Well, you've just seen it. This is why, okay? Your expected return in these cases is 0, and it doesn't change if you lose leverage. All you are doing when you're using leverage is leveraging a 0 expected return, which is still 0. The more leverage you use, the faster you're going to be wiped out when you apply it to day trading major indices and major currency pairs, okay? You're always going to get caught out on 1 or 2 incorrect guesses. It's just not a question of if you can do it. It's just simply a question of when you're going to get wiped out. Now, obviously, ask yourself the question, what's the agenda here? If you think about the previous video when we looked at all the conflicts of interest, ask yourself the obvious questions. Why do some brokers allow me, a total stranger, to leverage 5 times in stocks, in indices, and 30 times in major currencies? Why? Well, a lot of it is because of the conflict of interest, okay? If they're charging a commission, spread, and margin financing, they obviously prefer bigger numbers because you get charged on the bigger numbers. You don't get charged based on the amount that you put in your account. You get charged commission, spread, and margin financing on the bigger number, the number that you trade. And obviously, they're also selling your data. So even with free trading, we haven't even added in commission costs or any costs to those numbers. Imagine if you added some costs into those numbers. I mean, it's even worse, obviously. You're basically sitting at 0 all the time. They also know that because you're doing it this way, okay, and this is coming from the very top of brokerage firms, not, the average guy that works in the office, because they just wouldn't know, okay? But this is coming from like management level. They know that if you're going to day trade major indices and major currency pairs, that your odds of making money over many trades over a long enough period of time, okay, so N days, in infinite days, your odds of making money are 0, okay? In the international context, this would mean taking the other side, so they have an extremely high percentage probability of making money. So taking the other side and running the position against your position and then closing out when you close out. And in the US case, which is more prevalent now in the free or commission-free trading platforms, it means more money for their data because they have, like we mentioned in the previous video, what they call a data business. Go figure, okay? This is what we're talking about here, guys. Leaving the level of unconscious incompetence and becoming conscious, understanding. Now, of course, the next step is conscious incompetence. But, first step here, guys, we've got to teach you how to leave this level of unconscious incompetence, okay? And day trading, the S&P 500, NASDAQ, Dow, Russell indices, major currency pairs, it's random. It's random. And we've put numbers, we've put meat on the bone, okay? We've put numbers in front of you to show you this, okay? By definition, by your own retail trader ambition, which is to make money consistently over time using your own money in the retail trading infrastructure, okay, it's not a viable strategy, okay? It's not in sync with your aim to become consistently profitable using your own money within the retail trading infrastructure. Stay away from it, okay? This is something that is sold to you as a hack, a panacea, something that you can do to get an extra income. etc., etc. You've all heard the pitches before from the conflict of interest, the inhabitants within the retail trading infrastructure that exhibit conflict of interest, okay? You don't necessarily understand how it works. Why? Because you're unconscious. You don't understand the industry. You don't understand how it works. And you don't understand financial markets history, statistics and data, and odds of making money in asset prices over certain timeframes, okay? So the vast majority of people fall for it, and the vast majority of people lose money. Now you know. Don't do it. Now, of course, like I said earlier, I highly, highly advise that you go to the download section and you look at all other assets. You start getting used to these processes and you start looking at the gates, the probabilities of making certain amounts of money over certain days, and understanding financial data and statistics and understanding probability. With opportunity, stick to what's probable, not what's possible. With risk, stick to what's possible. Okay, that's how you've got to think about things. Now, in the download section, we have multiple assets that you can look at. So, as mentioned previously, we've got the S&P 500, NASDAQ, Dow, Russell 3000, 2000 mid-cap index. We've got, in currencies, euro dollar, dollar yen, cable, sterling US dollar, Aussie dollar, US dollar, and we've got some more volatile currency pairs in there as well. When we look at, say, for example, dollar South African rand, dollar Brazilian real, dollar Turkish lira, we're essentially looking at emerging market or commodity currencies. They tend to be a bit more volatile than the than the major currency pairs. We've put them in as a few examples. You know, you can go and have a look yourself, and of course you can get the data online. Chris is going to show you that in the next video. You can go and look yourself at all the other currency pairs that are out there. Just replicate the process and understand the numbers, okay, over different time horizons. And of course, again, as I mentioned, don't just use open to close to close. Have a look at high to low as well for the maximum opportunities. Because obviously high to low is the maximum you can make, okay, or lose in a day, depending on if you get the direction right. And always remember, you have to get the direction right. Now, in the stock market, we also looked in the download section at mega cap stocks. So we'll come on to some definitions soon about market capitalization and how mega caps, large caps, mid caps, small caps are defined. But mega caps, we decided to look at some popular names like Facebook, Apple, Amazon, Netflix, Microsoft, Google. In large cap stocks, we have a whole bunch of stocks that we looked at there. And in mid cap, S&P 1500. So large cap is still within the S&P 500, but when we go further down the market cap chain, we get to mid cap stocks. We looked at a whole bunch there as well. We just picked them out to have a look, a good representation across large caps and mid caps. And we did open to close and high-low analysis of all the returns distributions, so standard deviation for all of these assets. Highly advise you to go and have a look at it. We're going to have a look at the results now overall, and have a look at the results when we look at different levels of the market compared to each other and different instruments compared to each other. And you can get all of this information in the download section. But first, let's have a look at some definitions of market capitalization. You'll often hear in financial media people referring to different market capitalizations of stocks with definitions like mega cap, large cap, mid cap, small cap, and even micro cap. Well, what is a mega cap? Roughly speaking, it's anything greater, any stock greater that has a market capitalization greater than $40 billion. A large cap stock at this moment in time is defined as a stock that has a market capitalization of anything between 10 to 40 billion. A mid-cap stock, market cap anywhere between 3 to 10 billion. Small cap stocks, 1 to 3 billion market cap, and micro cap anything under $1 billion. So when we look at the major indices, if we think of definitions, the Dow Jones Industrial Average, the whole thing, the 30 stocks in there is considered mega cap. The S&P 500, that's considered both mega cap and large cap. NASDAQ 100, that's considered mega cap and large cap. Russell 2000, that's considered small cap and micro cap. So now we got the definitions out of the way. It's worth having a look at all of these assets. And if you go to the download section, this screenshot is from the distribution of returns summary file. Okay. And here we're looking at high to low. So we're going straight to the maximum opportunities of all asset prices that we've sampled over a daily, weekly, monthly, and quarterly time frame. Okay. And we start to see some quite startling results. Let's have a look at the first column where we've got the names of the assets. So first of all, we've got government and corporate bonds. We've got Forex, so major Forex pairs, emerging markets, commodity currency pairs. We've got an equity indices total, which is made up of Dow Jones Industrial Average, which we're looking at individually as well. So Dow Jones Industrial Average, S&P 500, NASDAQ 100, Russell 2000. So that total makes up all of those. And then we've gone into the stock market. So we've drilled down into the indices and we're looking at different stocks or different groupings of stocks based on their market capitalization. So we're looking at mega cap. So the FANG stocks, including Microsoft, large cap stocks and mid cap stocks. So let's have a look at some of this data. And we're also going to introduce you to a concept now of opportunity set. So when we look at this data, we can see that there's some quite startling results. When we look at the daily data especially, let's compare, for example, the opportunity to make money in one day between FX major currency pairs and mega cap stocks. So FX major, 1%, just under 1% on a daily basis. Mega cap stocks, 3%. So the opportunity in large cap equities, the mega cap equities, so the FANG, including Microsoft, opportunities on a daily basis, far greater than Forex. Okay. Large cap stocks as well compared to Forex. Mid cap stocks compared to large cap and mega cap on a one-day basis, much bigger. Now you can go through all this data yourself. We'll highlight some key differences here that are great lessons of financial markets. But you should also look at this data yourself and go through it to try to understand it. Think about what we're doing now in terms of these time horizons. We're extending the time horizon to both weekly and monthly and even quarterly. Okay. So in the previous video, when we're looking at, and up to this point in the video series, we've always referenced the 1 to 3 month time frame. Well, what you're looking at there, monthly and quarterly, is the 1 to 3 month time frame. And in the stock market, that's the 20 to 60 day time frame. Now let's have a look at the samples. So you can see for government bonds, we've got TLT, IEF, IEI, SHY, corporate bonds, LQD, VCIT, JNK, HYG. You can see the major currency pairs, the EM, more commodity currency pairs that we've sampled. You can see the equity indices total, what we've sampled, S&P, NDX, Dow Jones Industrial Average, the Russell 3000 and the Russell 2000. You can see we've sampled the most volatile mega caps that are available to us, just to see what the numbers are, which is the FANG, including Microsoft. And we've got large cap stocks, If you want a list of all those, they were on the previous slide. Same with mid caps. You can go to the download section and see all of these, okay? But essentially, if we start looking at the high to low average returns for all of these samples over a monthly and quarterly basis, you can see that some of the numbers are amazing. If we go down to the market cap chain, and we start, for example, comparing the large cap stocks that we sampled relative to, say, for example, the NASDAQ 100, which is obviously very volatile for even an index, okay? Look at the large cap monthly, 17.6 versus NASDAQ 100, 9.2. Look at the quarterly, 36% versus 18. Essentially, you have double the amount of volatility at the stock level in large caps, the large caps that we sampled, versus the index level at the NASDAQ 100. And NASDAQ 100 being the most volatile index. Additionally, if we look even further down the market cap chain and we look at mid-cap stocks, monthly volatility of the ones that we sampled on average, 26%. Quarterly volatility on average, just under 53%. So over a 20-day time horizon, you're looking at high to low volatility of 26% and 52% versus the rest of the data sets. Astounding. Now, what's quite interesting is the mega cap FANG that we've sampled, monthly 20%, quarterly just over 40%. That's still pretty good, obviously, but there's a problem. There's only 6 stocks. Welcome to the concept, the reality of opportunity set, which is very important for retail traders. Well, not just retail traders, all traders, okay? It's just that retail traders don't know this stuff, okay? Opportunity set is important for all traders because what we want to expose ourselves to is obviously volatility over the time horizon we choose, okay? The market dictates to us where those opportunities exist in terms of volatility over certain time horizons. But what the market also dictates to us is the opportunity set within that volatility construct and within that time horizon. So, for example, if we look at government and corporate bonds, there's only really 4 to 5 viable products that we can actually trade in both government bonds individually and corporate bonds, the ETFs. So things like the TLT in government, JNK, HYG in corporate bonds. There's only 4 to 5 viable products. So imagine as a trader, you say to yourself, I'm going to trade on a monthly to quarterly basis, only government and corporate bond ETFs, because I know them really well, okay? Well, it doesn't matter how much you know them, okay? Financial markets history, the data, the statistical history tells us what the opportunities are over that time horizon. What it also tells us, and this is something that we can't change, we can't do anything about it as traders, they tell you the amount of instruments that's available. So the amount of volatility is important, but the amount of instruments that are available is very, very important too. Same with Forex, okay? We've already seen that day traders in Forex either spend most of their time just losing money, expected return 0 in the major currencies. But even if or they sit on their hands and do nothing for a long time, waiting for the big payday. But if we add emerging market currencies, commodity currencies to the mix, when we've sampled 1, 2, 3, 4, 5, 6, 7 here, right? If you add up all major and emerging market commodity currency pairs that are available for you to trade in the world on retail trader platforms, you're only looking at approximately 15 pairs in total, okay? And, the major currency pairs are G8 or G10 currencies. The amount of wholesale opportunities to make money because of the amount of instruments, the opportunity set is very small, okay? Additionally, we know that the volatility is not great. Okay. When we look at daily volatility, it was terrible. The expected return is just zero over enough trades over a long period of time. If we extend out to weekly, it's still not great when we look at it in absolute terms and relative to other instruments, tradable instruments out there. Even over a monthly and quarterly 20 to 60 day time horizon, it's not great, especially when we compare it to other areas of the market. When we look at the equity indices, Dow Jones Industrial Average, 30 stocks. Here we're trading at the index level, so we're looking at the average of the constituents within that index. But when we analyze what's in there, Dow Jones Industrial Average, it's all mega cap, okay? So we shouldn't expect huge amounts of volatility, much more of an investor's index where you buy and hold stocks for a very long time. We talked about time horizon earlier. We'll go over that briefly again soon, just as a reminder. But essentially, not a trader's market. Not a trader's market. No wholesale amount of opportunities moving in a big way in the 1 to 3 month time horizon. Same with S&P 500, NASDAQ 100, Russell 2000. When we start getting to mega cap, we start to see some volatility. But when we look at the breakdown of indices, 160 mega caps in the S&P 500, 250 large caps, 90 plus mid caps. So it's mostly mega cap and large cap with some mid caps thrown in terms of market capitalization. NASDAQ 100, it's all mega cap and large cap, only 100 stocks there, 56 mega caps, 44 large caps. Russell 2000 extended out further down the market cap chain, 240 mid caps, 610 small caps, and 1,150 micro caps. When we get to mega cap, don't forget we've chosen the most volatile mega caps. So when you look at, for example, the S&P 500 and you see that there's 160 mega caps in there, the rest of them are going to be less volatility than these. We just put it in the table as a yardstick, the sample as a yardstick, so you can understand what's the most volatile out there. The problem is there's only 6 of them, okay? Back to this idea, this reality, this concept of opportunity set, okay? As traders, we want to be exposed to volatility, but we also want to be exposed to multiple opportunities all the time, okay? Where does the volatility exist in the market? Where do wholesale opportunities exist? This is how we get consistency of returns, because there's consistency of opportunities and volatility. That's key. It's very important. Otherwise, you'll end up being one of those traders who has flashes in the pan, where at a particular moment in time, you get the right side of something and make some money, but you spend a long time exposing yourself to things that are not opportunities because the market is not giving you wholesale opportunities. The opportunity set is too small. Okay? Where is the volatility? Where is the opportunity? Well, if we look at this table overall and we look at the definitions, large cap and mid cap stocks, that is where the volatility and the opportunity is. There's hundreds of stocks, both in large cap and mid cap, always changing. So they'll go from large cap down to mid cap and mid cap up to large cap. There's hundreds and hundreds and hundreds of stocks that are moving like this, that are very typical of these numbers. So large cap, 17% over a month on average, the sample that we sampled. Over a quarter, 36%. Mid-cap stocks from our sample, 26 and 53. So 26 for a monthly average, 53 for a quarterly average. There's hundreds and hundreds and hundreds of stocks trading like this every month, every quarter, month in, month out, quarter in, quarter out. Where do we want to be concentrating as traders? Where there's volatility and where there's wholesale opportunities on a consistent basis. That's where we get consistency. So where do we want to be concentrating? we want to be concentrating on the 1 to 3 month mid-cap and large cap positioning for maximum opportunities and volatility. And remember, this is the data from high to low. So the high to low on a day, the high to low on a week, a month, a quarter. This is where we want to be concentrating. It shows us the maximum amount of opportunity to make money over those time horizons. We want to be concentrating on 20 to 60 day time horizon, 1 to 3 months, mid-cap and large cap positioning. This is where it's at. Now, you will see in the download section, when you download the distribution of returns summary file, you will see the constituents of the indices that we have taken out to look at individually and as a group, the sample size. Remember the definitions of mega cap, large cap, mid cap, small cap, micro cap. Large cap 10 to 40 billion, mid cap 3 to 10 billion. Here's our samples of the large caps and the mid caps. So we've just taken a screenshot here for you to summarize it. You'll see a whole bunch of large caps in there, a whole bunch of mid caps, and you'll see both the close to close standard deviation and the high to low return average. And of course, you know, the summary table covers all of this. When we look at the total average of the samples, these are just the individual stocks. It compares them to obviously government bonds, corporate bonds, all FX, both major EM commodity, compares it to an equity indices average and also each individual index for equities. Go through, have a look. Go and have a look at all of these stocks individually. You'll see some of the numbers are great. You know, you've got volatility here on a quarterly basis of some mid caps of 50, 60, 100 plus percent, 70%. There's a lot of volatility there, and there's wholesale opportunities. That's the point. So familiarize yourself with it. Obviously, you know, when Chris shows you in the next video, you can go over any asset once you understand how to do this and understand the opportunities and the risk. So we encourage it. Go for it. The beautiful thing is about this area and this time horizon and the volatility over that time horizon is that these names change over time, and there's always hundreds and hundreds of opportunities to potentially make money to take advantage of. This is the 20 to 60 day long short portfolio management time horizon. As mentioned previously in the previous videos, this is where the vast majority of professional traders attempt to get returns on both a wholesale basis, the opportunity set, and because of the volatility that is exhibited throughout financial markets history and presented as expected return. But let's conclude. Let's finish up here before Chris shows you how to do everything for yourself. The tradable set of both sovereign and corporate bond instruments genuinely are not even an option, guys, for retail traders. There's no wholesale opportunities to make money in that area. Can they provide hedges? Can they? Yes, of course. We're not looking at exceptional circumstances, okay? We're not looking at the one time in 3 years when you might use one of these instruments. We're looking at an overall trading strategy, okay? You want to make money out of your own money on a consistent basis. You need wholesale opportunities, large opportunity set that presents itself to you, and wholesale volatility, okay? For retail traders to get wholesale opportunities and volatility, you've got to go somewhere else. You've got to go somewhere else in the market to stand the best chance of making consistent returns. Now, when we look at the summary table and we look at equity indices, we can see very, very clearly that over all time horizons, they're more volatile than major currencies. They're even as volatile as the most volatile commodity and EM currencies. So I think you get the point by now. Generally speaking, equity indices are more volatile than currencies. Do not fall for the narrative that currencies are more volatile than equities. They are not, okay? Financial markets data proves that over and over again, okay? Overall, equities, in terms of opportunity set, there's more opportunity and risk, so therefore volatility, more opportunity set as well than anywhere else. You've got 2,200 stocks compared to, for example, in Forex. We mentioned 15 currency pairs earlier. If we go right out to the maximum, we're looking at 25. But a lot of trading platforms don't have them on. Okay, you might only get 10 or 15. So you're comparing an areas of financial markets where there's 2,200 opportunities to make money versus 20 to 25 opportunities. Okay, it's not even in question. It's not even in doubt. Okay, if you're going to apply an aim in financial markets to go out there and have the best chance at making consistent returns, you need wholesale opportunities, the largest opportunity set possible with volatility. At the macro level, the top level of equities, there's 2,200 stocks. At the top level, the macro level of currency pairs, there's maximum 25. You might get 20 on a platform, you might get 15. In the bond market, 10 products, 10 instruments that are hardly volatile. They hardly move. Okay. So 10 non-volatile ETF instruments. It's not even in doubt, guys, where you should be. Now, day trading opportunities. When we look at the data in the summary table, and from the work that we've gone through here in this video, day trading opportunities at the index level for equities and in currencies, we now realize, well, you should be starting to realize or fully realize by now, massively over-exaggerated by inhabitants of the retail trading infrastructure that have typically got conflict of interest. Okay. Additionally, day trading and even weekly trading when it comes to indexes, S&P 500, NASDAQ, Dow, currency pairs, it's futile and the odds are against you. Go and check the data. Go and have a look at it in the download section. It's futile. The odds are against you. We've shown you some highlights here with the S&P 500 and euro dollar. Your expected return in day trading these popular instruments, your expected returns are terrible historically, even when you're when you're using the high to low data when compared to open to close or close to close. It's just terrible, guys. The evidence is there. Please go through it. Now, absolutely critical to you becoming a student of financial markets data and understanding volatility, understanding financial markets is getting to know these numbers, getting to grasp with them, and knowing that to get wholesale opportunities and volatility, okay, you have to go to areas of the market and you have to extend your time horizon where you get those things, okay? Absolutely critical to understand that, guys. So extending to the 1 month and the quarterly time horizon, and then going into the constituents of these indexes in equities, okay, and going down, lower down the market cap chain to mid cap and large cap single stock equities gives you wholesale opportunities, multiple opportunities, and historically high volatility, which enables you to make consistently high expected returns. Okay. Very, very important to understand that. Okay. So again, learn this stuff and you'll see the numbers and you'll start to understand them and you'll start to understand where you have to be in financial markets. Now, of course, if you want to take less risk and you want a lower expected return, well, first of all, you need to be asking yourself, are you really a trader? Probably not. If you want low risk and low expected return, of course you can get it. We've seen that. But obviously, don't expect to get high returns in a short space of time. You won't, okay? This is not trading. If you go after that type of risk and return, it's not trading. It's long-term investing. That's what usually is the case. Likewise, if you want a chance at high returns in a short space of time, and remember, 1 to 3 months is still a short space of time, okay? If you want that chance without becoming an investor where you have to sit around for 2-3 years to find out if you're right or wrong, and most likely wrong, of course you can get it. You can expose yourself to this possibility. We want to be traders, and we want to try and make money in a shorter time frame. We don't want to be sitting around waiting for years to find out that we're wrong. Okay? Boring. Probably not going to work. Okay? Of course, point to the exceptions. There's always exceptions. But as a general rule, okay? What we cannot do, okay, is change the numbers. We can choose where to be in the time horizon. We can choose what we want to be exposed to in volatility. What we cannot do is change the numbers. What do we mean by that? Transposing our own requirements onto the market. So for example, like we've discussed in previous videos, a retail trader's requirement to make an income from trading or a predetermined amount in a predetermined short space of time. It's completely irrelevant, okay? Why? Because the market dictates the opportunities and returns that are available in the asset prices over the time horizon you've looked at, okay? Not the trader. The trader doesn't choose it. And definitely not a charlatan trading educator, or even worse, a broker, okay? The market dictates the opportunities, guys. You cannot go into the market and transpose your own requirements onto the market. The best you can do is look for wholesale opportunities, so areas of the market where there's a large enough opportunity set where you can get a large amount of opportunities over a certain time horizon, and the volatility over that time horizon is big enough for you to try and get returns out of, okay? What you certainly can't do is say, I'd like to make $5,000 a month so I can cover my bills. You can't, okay? Even worse, if you think you're going to do it with day trading, okay? You're going to have months where you're down sometimes. You're going to have months where you're up. This is in the 1 to 3 month time frame. And overall, of course, you're trying to be up, but this is not a situation where we're looking for income. We're looking at our trading account as an asset and growing that asset as part of our balance sheet as human beings. We're not in this game to take money out of our trading accounts on a regular basis, okay? And we're certainly not in this game to walk into financial markets that have exhibited very clear levels of volatility and then transposing our own requirements onto those asset prices, and our requirements are absolutely not realistic, okay? Where we're putting our own expected return onto an asset that has a very clear expected return. That's just unconscious level retail trader stuff, okay? Professional traders understand volatility, and we know what it means, okay? Retail traders really lack this understanding. Consequently, they're always failing. They're always falling into the trap of making bad decisions, which obviously means the vast majority of them fail and keep going around in circles at the unconscious incompetence level. So obviously this video is a lot to take in. Big video again. But let's have a quick reminder of where we are, where we want to be, emulating professional traders, trying to make money on a consistent basis. the time horizon spectrum, we're not day trading. We're not retail traders over one day. Also, when we looked at the data, we probably don't want to be over 1 week. Okay. When we look at all of the data, if we want wholesale opportunities and we want maximum volatility that we can get, so we can mine the data set, we can mine the volatility and the amount of opportunities. We're spoiled for choice. Where do we want to be? The 1 to 3 month time horizon, 20 to 60 days. Do we want to be investors? Do we want to be retail investors, income and value investors, sitting around for 1, 2, 3 years, where stock prices stay where they are or go down and we receive some dividends and we sit around waiting and waiting and waiting for something to happen? No, we are traders. We want to make money short term, but there's a catch. We don't necessarily find ourselves in the 1 day time horizon or even the 5 day time horizon because we need volatility. We need opportunity set and volatility. So where do we go? We go to the 20 to 60 day time horizon where there's hundreds and hundreds and hundreds of opportunities all the time that are always changing, where we've got mid caps and large caps that we can take advantage of. We build long short portfolios and we hit the sweet spot of volatility. That's where we learn. That's where we mine. That's where we get our opportunities and we get our P&L. Okay. Within that space, we still have to have a pro trader systematic process to enable long short portfolio management in the 20 to 60 day time horizon. Okay. Remember, this was split up into theory and implementation. The vast majority in fundamentals, quantitative and qualitative processes to generate trade ideas. Where are we going to find that? At ITPM. That's in the PTM video series and the PFTM video series. Timing, only basics required. So getting a fundamental bias and then timing it. Then we move from theory to implementation. Trade structures, that's in the POTM, the options trading masterclass, and getting real money experience, because we're always looking for catalysts and trade structure around those catalysts that is optimal for the highest ROI. And then, of course, we have both preemptive and reactive risk management, how we set the parameters of the portfolio that we're going to set up, and how we're going to trade after we've actually got positions when news comes out. So both preemptive and reactive risk management. If you want to do those programs, that's the next step. But for now, of course, what we're going to be doing here in the introduction to professional level trading is continue on our path and obviously keep helping you lift out of the unconscious level of trading, unconsciously incompetent level of trading. And Chris is now going to teach you in the next video. Chris is going to teach you how to actually implement all of these processes so you can understand how to do this forever yourself for any asset over any time horizon, as long as you can get the data set, which, by the way, the vast majority are available online. And Chris is going to show you places where you can go and get that data. And it's all very straightforward. You've just got to learn it. And the good news is once you know how to do it and you've learned it once and you repeat it, you can do it forever. Okay? It's very straightforward. Just learn how to do it and repeat it. Downloads for this video, multiple spreadsheets and resources of the various asset prices that we've looked at to assess the data and practice measuring the realized volatility. But for now as well, head over to the next video. Chris will start showing you how to do this. As long as you can get the data, you're going to be able to do this forever by yourself to get the volatility profile and therefore the opportunities and risk in any given instrument or asset classes out there, okay? Very important skill to learn. Introduction to professional level trading. This is how pro traders do it. Keep going, guys. It's a lot of work, but it's all fairly straightforward once you start getting it. And I'll see you at the end of the next video.